And
Sorry.
no worries. And I've been in Tucson for 16 years, originally from California. I've done everything in the business from, administration to processing, originating. I've been a director on the builder side of the business. I've been in underwriting, and I've also been a realtor. Um, so I really, for me on it, it's just with my background on it, it gives me a lot of different options on helping people, whether or not it's home related, it's finance, it could be, I just have a very unique past on it because I've been able to do a little bit in our industry for a long period of time in different aspects of it. And it really helps me with when people have questions in different situations they need to deal with so we can come to solutions. And honestly, it is my passion on it. I mean, Mara mentioned financially free. Um, and that's a weird conversation to have when you're talking about potentially taking out a mortgage to buy a home on it, which is a debt. Um, and in my opinion, it is the only debt that is really something that is advisable on it within means. And it's really managing the rest of those things on it so debt doesn't become a burden. It is a big part of the financial process that a lot of first time home buyers don't understand the ramifications of what happens when you buy a home on it. So it's a really good thing to go in it the right way on it, and that's a lot of the reason for this call today and this podcast is really to get everyone set up for whatever their steps are, wherever they're at in life on wanting to buy a home on it to get them going in the right direction so that they have that ability to do it when they're ready.
And Steve is just awesome at that. He's such a big picture guy, and we'll just talk about that some more. That neither of us are here to sell you anything. We're here to help you through the process. And Steve decided he'd like to tell you the things that my clients have said about me, and I'll tell you some of the good things they've said about him.
Yeah, and a lot of this is just to get a little mindset of how we are with our clients on it. In our industry, it can be somewhat, driven by sales and stuff like that. And in both of our opinions on it, that is just not the right way to deal with home ownership on it. It is a journey for people on it and is a lifestyle change, and it can set up their life for success or failure depending upon how good of a job we do. So who you work with is just as important as what you buy. To make sure you have the people that are working for you in your corner, that they're out for your best interest, that they're not just out for a commission or some kind of, other way to get income from you on it versus truly looking at what's in your guys' best interest. So this was a client of Mara's. Mara's absolutely wonderful. I'm truly lucky to have had the experience of working with her. She is the epitome of professionalism and kindness. As a first-time homebuyer, there were many things I needed guidance with, and Mara helped me through with thorough communication and great explanations throughout the entire process. She went above and beyond to make sure I was comfortable and understood everything along the way. I would wholeheartedly recommend Mara to anyone looking for a realtor.
Oh, me too. And one more, this client just also had some really nice things to say. And again, it's just obviously really nice when we do a good job for folks and they obviously appreciate it because again, we're there to hold your hand through the whole process and you'll have some other professionals doing that as well. But it is a stressful thing. I would not pretend that it's not. So it's good to have someone in your corner that knows what the heck they're doing, frankly.
Yep.
Um, then for Steve, this is one of of his reviews. Steve and team made the impossible happen. They found a way to make my unique situation work out for the best and helped us find a solution that helped my family and I get into the home we wanted smoothly and timely. And another, Steve was outstanding, professionalism, responsive, and supportive from start to finish. They made the home buying process clear and stress-free, and I'm very grateful for their help. I highly recommend them. So again, hopefully you see, you don't have to take our word for it. We got, and that's just one of, or a couple of many wonderful reviews that we're grateful to have. So moving on to some of the basic steps of homeownership. Obviously, we can't go over it all tonight in an hour, but obviously coming to this class is a great start. Getting approved, hopefully with Steve in the future, or working on credit repair, house hunting with me, hopefully as your realtor, and then moving into your dream home. So those are sort of the basics. The first mistake, of course, people make is not checking which programs that you might qualify for just because of a special group that you might be in. And Steve is probably going to talk most about this. We try to stay in our lane, as we say, where he's going to talk most of the lending side and me more of the housing side. So, Steve, you want to talk about this slide?
Absolutely, yes. One of the biggest misconceptions about our industry is that, you know, the loans that are out there for first-time homebuyers or different professions, they a lot of people feel in the consumer side of the world that it's like, oh, it's only if I ask for them. And truly, if your loan officer and or your realtor are looking out for you on it, this should be a conversation that any of them have along with that they have with you. Obviously, different situations, some backgrounds, in terms of professional backgrounds, or technically, even Native Americans on it. There are some special programs that are out there for them. And a lot of times you hear, it'll be this. I mean, I got a call and I heard it from another loan officer from another company on it that I received on it. And she was quite discouraged. She was a Native American, and the type of loan is called an FHA 184 program. It is specifically for Native Americans, and there are some requirements to it, but the lender just basically said, oh, that program's not competitive. You don't need to know anything about it. I have another program for you. Well, part of the journey of being a first-time home buyer, because the language that we speak in real estate and mortgage, it's not English. It is a completely different language, and I think that they created this language just to confuse home buyers because we use words that mean absolutely nothing to home buyers, and we expect them to just know when we say it the first time without explaining what it actually means. So, first-time home buyer programs that's a very interesting way to say it. So, yes, there are some programs really driven for first-time home buyers that include down payment assistance, all of those things on it. But technically, a lot of the programs that are out there that offer this are more income driven than they are necessarily whether or not you're a first-time home buyer. Now, there are some grants for first-time home buyers that do exist, but it is not always the case on it. So we're very careful in the lending world to call them first-time home buyer programs all the time. Even though everyone addresses them as a first-time home buyer program because they're getting a grant, but they don't necessarily need to be a first-time home buyer to do that. There are special programs out there for Native Americans, and that is just due to some old legislation inside of HUD, due to just some of the things that the government and the Native American population have had to deal with in the history of that. And we don't need to get into the politics or the reality of it, but that is really why that program is specific to them. First responders, that would be police officers, firefighters, nurses. There's some of these programs that are first responders that include teachers. They are considered on the front line. They may not be responding to a medical emergency or a situation that requires the police, but they are at the front line of teaching our next generation and the generations to come to get there. So there are some programs that first responders do include teachers as well. Active duty military, it can be National Guard, it can be it can be Coast Guard, it can be any of the other branches of the military. And veteran is really not an active duty person, but it's anyone who is retired from the military and was honorably discharged that allows them to do a specific type of financing for veterans only or active duty people that allows them to do 100% financing without any mortgage insurance at all. It is arguably the single best loan out there, but it is only limited to any military personnel that have met the eligibility requirements for that. When you're looking at these different programs, you may wonder why the loan officer or me is asking you questions about who you are. It is not to make you uncomfortable. It is really an inquiry into what options can I give them based on their situation. Could be income related. It could be your ethnicity. It could be all of those things on it. And all of those things could combine where you could combine multiple grants at the same time. So this is why these questions are important. It is not to intrude on your personal life. It is really to try to get you in the best situation possible that gives you the best advantage to be a success by owning a home. The last thing we want to do is to put you into a home because it's a program that made more sense for us than you. Mm-hmm. And it is important to know that in our industry, part of who you choose to work with, you need to make sure you have the confidence and the faith that that person is really looking out for your best interest and you feel that way. Comfort is only personal. You may not like me, you may not be comfortable with me, you may want to use someone else. I'm totally fine with that, because the ultimate goal for a first-time home buyer or anyone delving into buying real estate for the, even the second time on it, it is very important to trust who you're working with. It's not just about numbers all the time. There are certain things in your financial past that we might have to, maneuver around to ensure that those things never happen again. And there might be a conversation that may not be the most comfortable for you, but in the end, we're really trying to look out for your best interest to set you up for success so that you really can flourish inside of owning a home and build some wealth for you and your families.
Sounds good. Just a little bit more on those homebuyer grants, just because people hear about them, so we wanted to just go into that a little bit more.
Yes. So the word grant is misleading, because for people who are in college or have gone to college, you get a grant. It is something that is given to you. It is free, correct? In exchange for your background or your grades or whatever, we're going to give you a grant because we think you're going to be a good fit and you're going to make our college look better. So that is a tricky word in our industry, because grants don't mean the same thing as they do in the real world. Some grants are required to be paid back, some are forgiven. The one thing to know about any program, and this is very important, if you don't take anything other than this about first-time homebuyer loan programs, there's no such thing as a free lunch. So you are going to give something in order to get something in regard to that. So you may take a slightly higher interest rate to get some down payment assistance to get you into your home. Now, does that mean that you have to forfeit your budget and go above and beyond your means? No, that means we just need to account for that when we're setting up a budget for you and looking at those things. How do you qualify for this type of loan, or looking at different grant options that may be available to you? The very simple answer is, and no buyer likes it when they call just to ask me questions about it, because technically I can't answer that question until I actually see your financial situation. It could be credit driven. It could be your ethnicity. It could be your income. It could be where you work in Tucson. It could be who you work for. It could be what you do for a living. There's a lot of different factors and a lot of different grants. And to be honest with you, in Tucson and in Arizona, I'm not going to just say Tucson and Arizona, there's about 37 to 40 different programs that are available, but you don't fit into every one of them. And we need to figure out a way to put you into that program and see what you do fit into, so we can give you advice on what makes the most sense. The forgivable second mortgage is more what we refer to as the grant in our world. If it is forgivable, that means it sits on your property for a period of time, normally either 3 years, 5 years, or in the very worst case, 10 years. And after that period of time, that grant is gone. And what it means by forgivable means that you do not have to make a payment on that assistance. However, the downside of that is that you can't do anything until that grant is forgiven. It is a lien on your property, and until it's forgiven on it, it's very difficult to get financing around it. Down payment assistance is normally what we call a pay for play. So we can do 100% financing, but let's just say you make a little bit too much money for a forgivable loan. We do even have down payment assistance programs that have a very small second attached to them, 8, 9, 10 grand, whatever it is, that has a payment of probably $50 to $100 a month that is paid out over 10 years. This is a way for people who may make decent money but don't have a lot of savings for whatever's going on in their life on it, but they can afford the payment. They just can't, they haven't been able to save, 10, 15 grand for down payment or whatever their down payment requirement is. It still gives them an option to pay or to buy a home with putting little or no money down. So those are kind of the different things with regard to first-time homebuyer programs that are available and out there for you.
Right. All right, and all this again is going to sort of work together because we move into the second mistake, not getting a pre-approval. So Steve's talked about all these different programs out there, and it will be just wonderful in guiding you through it. But we do need some sort of pre-qual before we go look at homes. It is required on the Arizona purchase contract. It says we have that, or we have proof of funds. So no one would take our offer seriously, and we don't usually go look at homes without that, because don't want you to fall in love with a $400,000 home and then be able to afford a $300,000 home. That's a terrible way to get started. So we just like to make sure, and Steve will talk about, even though we're pre-qualified for something, doesn't mean you maybe want to spend that much money. And again, we're both going to be sensitive to that. We want you to be able to afford your home and your life. So the three pillars: credit, income, and down payment. And this is sort of related. So Steve, you want to talk them through this?
Absolutely. So the number one of, I'm going to say objection, but it's more of a fear than an objection. It's not even so much an objection. Homebuyers are just scared. We all have a past. I have a past. Mara has a past. I'd love to say that the 51 years that I've been living has been perfect roses and I've never had an issue in my life. That's just not the way the world works.
No.
And your credit is your credit. Let's just get down to the brass tacks of it. We got to deal with what's so. You have credit issues and you're serious about doing it. I really hope that you can get to the point where you want to have a conversation about getting it right, because there are options that you have and there are ways to fix your credit that don't cost thousands of dollars. And I don't mean by thousands of dollars in terms of paying off debt, but I'm sure that you guys, if you do have credit issues or you try to look for resolution on it, you go to these companies online and they basically charge you a whole bunch of money to negotiate your debt with your creditors on it. And basically you pay it off anyway, but you give someone else money to help set you up to keep you on track to pay off your debt. I hope that sounded as crazy as the way that I said it, because in reality, you are paying someone to help you pay off your debt, where the basic understanding is if we teach you how to do it and teach you the reasons why it's important, and we give you the motivation to do it on it, it's technically something you can do on your own, and you don't technically need another company to do it for you. It does require what I refer to as blood, sweat, and tears. You got to dig in a little bit. You may have to make some sacrifices to get where you want to go, but it is something not to be embarrassed about. Believe me, if you want to have a conversation with me one-on-one about it, I can tell you about some of the things I've gone through in my life and why I am so much of a proponent of eliminating debt as much as possible on it. I can tell you that Mara has, I don't know her exact background with it, but normally when you talk about financial freedom on it, that means that at one point in our life, we weren't financially free and it sucked and we don't ever want to do it again.
Right.
And that's the reason for me. I'm not going to speak for Mara, but for me, I don't ever want to feel that way again. So I'm never going to get into debt again. So, and that is a very big part of it, is managing your debt, managing your family, managing your finances are all important. Income is important. The biggest thing about your income when it comes to qualifying for a mortgage is how stable it is. How much money you make is irrelevant. It may have you qualify for a lower home than you want to, but if you have very inconsistent income or you change jobs a lot, all of those things, those can affect you qualifying for a mortgage, because the number one thing that we're looking for is, do you have enough stability to pay a mortgage off for 15 or 30 years? We're not looking for a one-year history. We're looking for how stable you are over time, which is why it's sometimes scary to apply for a loan, because we're going to look into your past. But just know that if you're dealing with someone you trust on it, you're not being judged. You're really, that information is there so that we can help you to get either out of a situation or to better your situation. It is not a judgment. I can tell you, at least with me, I can't speak for every loan officer in the industry. I've had some crazy things happen in my life in the past. There's no judgment for me when it regards to credit situations and the things that go on with people. You have no idea the depth of understanding of what goes on in people's lives on a daily basis. And if we knew what was going on in people's lives, it would be a lot more graceful population that we had, that we would give a little bit of grace to people who are having a bad day, because we have no idea what prompted that bad day. Same thing with regard to income, credit, assets, all of those things that come on in your life. Now, I will tell you, assets are the least important factor of getting a home. However, building a budget that allows you to save money to protect against life happening, the stuff that I was just talking about in our past. Life still happens to me today. When life happens, though, do I have the means now to cover what happens in my life so that my family and my fortitude inside of keeping my family intact and stable inside of our home environment can stay put? And that's really what financially free means, at least for me. And I'm sure that Mara has a little bit of taste and flavor like that too. But in reality, the pre-qualification, it helps you determine how much you can qualify for. Now, here's the thing about qualifying. What you qualify for is not necessarily what you can afford. So lenders are very tricky sometimes where they'll be like, yep, you can get this, no problem. You should go out and buy this home for $300,000. But I told you I can only afford a $1,300 payment. Oh, don't worry about it. You qualify for this, you'll be fine. And the payment's $1,800. You fall in love with the home, you're like, oh, we'll figure out a way to make it work. And then all of a sudden, the slightest little thing happens on it, and now you're in trouble. So your budget and figuring out how much you can afford and qualify for are both equally important. So when you're pre-qualified, technically pre-approved, the pre-qualification is the simplest form. A pre-approval gives your bargaining power when negotiating with the seller to get you better terms, hopefully to get you a better deal for your family. It can give you an estimate of your payment, your total investment. Total investment is how much you have to put down or how much you're going to have to put into the transaction, if any at all, in order to buy the home. And the most important part is identify which product that will fulfill your needs. It's a very important line because the problem with our industry sometimes is it's what fulfills the loan officer's needs. And that's not the reality of where I'd love to, just take our industry and do just a clean slate sometimes for some of the people and some of the things that I hear that loan officers say to buyers. But it is really to fulfill your needs, which is part of the reason why we ask so many questions. We ask questions like, hey, I see that you told me you're getting married in 6 months on it. Are you planning on building a family? That is not pressure. That is something that's going to change in your future financially, that if we don't plan for it, we can set you up for failure without even knowing it. So those kind of things are very important for us to know. And when you see a loan officer and or a realtor asking those kind of questions, it really should not feel intrusive. You should really feel like you're really starting to be cared for by someone because they're actually starting to look out for your best interest. They're just not telling you straight out, hey, listen to me. I'm going to look out for your best interest. Don't listen to anyone else. They're really just trying to do their job to the best of their ability to give you the best advice possible to get you into a home and succeed in owning that home. Because getting into a home isn't necessarily the hardest part sometimes. It's maintaining the home and maintaining your finances when your family, when your son or daughter turns 16 years old and they want a car. And you're like, I need to get them a car. All their friends have a car. I need to get them a car. And I got this payment and I'm like, ooh, how do we do this? All those things come into play on it, and identifying and getting you into the right type of loan and getting your budget right sized on it is a very important factor for you to succeed in owning a home.
And as soon as Steve is even close to pre-qualifying you, I push him to tell me what interest rate you might get and doing net sheet so we know what that estimated monthly mortgage payment would be. And we need to know that early on, right? We don't want to make an offer on a house, again, that you can't afford. This one is some of the do's and don'ts when we get under contract. And I think Steve and I are going to share this one, but I think start with the do's, if you would.
Absolutely. So most importantly, call us if you have any questions on it. It is an age-old adage. There's no such thing as a stupid question. And there really isn't, because the reason for the question is for your financial future. So no question that you ask could ever be stupid or dumb or not important, because if you have a question for it and you're not getting an answer to that question, how are you possibly going to be comfortable enough to own a home? Continue living at your current residence. So what that means on it is that you don't, moving around a lot, all of those things on it. You got to look at all of these things. Stability is a big factor in it. So we don't like people who move around a lot. We don't like people who change jobs a lot. And we don't like people who take all their money out of their bank and keep it in cash. So the more stable you look like on paper, the better. Continue paying your mortgage or rent. Biggest thing possible, and it's one of the number one ways we get loans declined. They're in contract to buy a home on it, and sometimes we have to verify their rent history. And in the very last month before they buy the home, they're like, I'm not making that payment. I need to save some money for the mortgage on it that's coming up on it. So I'm just going to skip this payment and go there. Well, then when we go verify it and there's a late, it can jeopardize you potentially getting into the home.
Right.
The last one in this one, and then I'll let Mara go through a couple, and it's continue using your credit as normal. Most people think that when you're buying a home, I need to stop spending. We don't like that as lenders. That is actually considered a negative thing on it in our world because you're trying to manipulate your information to make it look better. So we look for stability not only in your income, your assets, we also look for stability in your spending habits. If you spend 3 months and then stop spending and then spend 3 months on it, it gets very difficult for us to understand how you're going to be able to afford this home on a monthly basis because this is a monthly debt. So we look for the more stable scenario inside of that. So continue dealing with your life as it is. We don't want you to change too much from there.
And just going back to the item before that, when you said keep paying your rent, we like to remind folks, say we closed on a house in March, you don't have a payment in April, your first mortgage payment wouldn't be until May. And they have set that up because I think they know people kind of stretch sometimes to buy a home, right? And they want you to be able to make your first mortgage payment. So that's just a tip that a lot of first-time home buyers might not be aware of. Just talking about that stability again, keep working at your current employers. So again, they're going to look at your work history. Again, Steve probably has more about this, but sometimes you might be able to change a job. Usually you want to be in the same type of job you've been in. And I know you like to talk about if you change to commission or something like that.
Absolutely. So things that are important here with regard to stability. I'm not talking about stability. I'm just going to use an example because she's my daughter on it and she's in the process of doing this right now on it. She's a nurse and she is looking to move to another company for a $10 raise, but she's still going to be a nurse at the new job. That is not considered unstable to us. That is considered a move to make you in a financially better position. That's not what we're talking about with regard to stability. Stability is things like this. If your income, how consistent is it? If you're a mechanic, you may work on flat rate, which means that you get the number of hours that you work on a particular project for a car when you're repairing it. There's different hours that you're allotted to that and you're paid off of that. It's technically like a commission job. We look for the stability of that job over a 2-year period. And in an ideal world, every year you're making a little bit more money. That is the natural projection that we are looking for. We don't want to see you made a whole bunch of money, went down, and you're kind of in the middle range now. How do we average that income and how do we look for stability inside this? The other thing about changing jobs on it is, say you have a full-time permanent job. The number one thing we see in today's world is not so much going to commission, although that would be a problem if you don't have a history of being on commission. A lot of companies today, they're trying to cut costs because of taxes, expenses in terms of owning a business. And you go from a job that is W-2'd, an employee of a company, and you go to another job that is the same line of work, but they're going to do something and we're going to make you a 1099 employee. They make it sound like you're still an employee, but technically a 1099 employee is not an employee of that company. They're a subcontractor for that company. And that would jeopardize you being able to buy a home for at least 12 to 24 months, depending upon the type of loan that you're looking at. It requires a history of stability because the type of income that you received is no longer an effect on it. You have a new income stream that we require some stability before we're willing to give you a mortgage.
And the next one, keeping your same insurance company. Again, as a first-time homebuyer, maybe not as much, but insurance companies are going out of states, and so people do change it sometimes once they own a house. And again, we're just looking at stability. Stay current on all existing accounts. Kind of what he was saying, we need to keep paying our bills right up until the day of closing. Well, and obviously, hopefully past that. But you just need to keep current on all of your bills because they will check your credit right up to the day of closing. And expect additional requests for documentation throughout. So it is a pretty onerous process these days, right? Since they had the big financial crash, they've just made lending a lot tighter. And again, if Steve, you want to summarize some of that.
Absolutely, yes. And honestly, expect requests for additional documentation throughout the process. The quality of the lender that you choose on it, most of this stuff should be handled up front. In my world, it's very rare that we ask for something very last minute or something that's going to jeopardize the transaction, because if we've done our job correctly, we should know pretty much well in advance of the closing date that you're ready to go. But there are certain things on it. For example, 1 out of every 4 loans that we do gets audited, and conditions can be added to your loan approval that the original underwriter didn't do. So there are things in place now after the financial meltdown in 2008 that we're much more stringent, and we have a lot more requirements that we have to do to satisfy the federal licensing that we are under. Unlike real estate agents like Mara, every lender that you deal with is going to be nationally regulated or federally regulated and licensed. In other words, that means we have to do continuing education. We have to submit to audit sometimes from our federal government, and deal with a lot of things to keep us going in the right direction. They do hold us to a very high standard in the lending world, and that is all a function of what happened in 2008, because everyone was a lender back then because the market was really good. And there was a lot of bad advice given to a lot of borrowers on it, and a lot of people that got taken advantage of. And they put a lot of things in place to avoid that happening. Did it stop a lot of it? Yes. Does it still occur? Absolutely. I would be lying to you if I said it didn't. I see it every day. For those of you guys who saw what I did, I'm actually the area manager, so I manage a lot of LOs as well. And I'm into a lot of the industry insights inside of our local market. And some of the stories I hear, they literally just make me cringe. So it still goes on. Is it the depth that it was before? No, but that's why trusting who you are working with is very important. I'm going to say it is the most important thing. People get so driven by rates. What's your rate? What's your rate? What's your rate? Honestly, I'd take someone that was an 8th higher in rate that looked out for my best interest every day of the week than going to that person who had the lowest rate and didn't give 2 craps about what I was doing the day after closing. On it is a very important factor because you have no idea. You're giving us every piece of your life on paper financially. You should trust that person pretty much with your financial life. And if you can't say that about that person, it may be a choice that you have to make where you have to find someone that you do trust and feel comfortable with.
And Steve is, again, amazing with his financial background, and you don't usually have to choose. He usually has the best rates and the best fees, and he's amazing. Going on to don't. Now, this is if we're in contract, and we're only usually in escrow, meaning we've made the offer, title is doing their thing, we're doing inspections, only for about 30 days, 45 max. So we ask you not to make any large purchases during that time. And that means, oh, we've got a new house, we need to fill it with furniture, let's go buy a bunch of furniture, because people have done that and then not been able to close on their house. So we don't obviously want to do that. Not changing bank accounts or making any large cash deposits. Again, that's that stability piece that Steve was talking about, not doing any big transfer balances, like with credit cards, and even getting ready to buy. Don't close any credit cards without talking to someone like Steve. Steve, you want to, again, go over part of that?
Absolutely. So I want to speak specifically about transfer balances because in today's world, we know things are expensive now. Everyone can see it. We're not blind to it. They can talk about the 3% inflation rate, blah, blah, blah. None of it's really accurate. I feel it. Everyone feels it. The cost of things in today's world are more expensive. So the transfer of balances on it is really a interesting thing that the credit card industry created because they make it seem like you're getting a good deal. But and most people read it, but they really don't figure it out on it. They normally give you a 12 months at 0% financing to transfer your balance to a new credit card company. They're like, great, I'm going to pay off my loan in 12 months. First thing you should know, the average transfer of a balance is $3,844 based on the most recent data we have from what is called the FRED, which is a government agency that releases a lot of credit data and economic data to us. Only about 12% of all buyers that transfer balances on credit cards pay it off in the 12-month period. So that's why credit card companies do it, because what you don't know is every time you transfer a balance, they charge a 4% fee on that transfer for the first month. So you're transferring a balance. You have an 88% chance of not paying off that balance in 12 months, which means you're going to get starting charge interest again, or you're going to transfer the balances to another credit card to get that 0% financing for 12 months and pay that fee up front. I'm going to say that is strictly a lack of understanding on how credit works. And it's our job to teach you that is one of the most detrimental things you can do to your credit and your financial livelihood. You want to get rid of debt? Buckle up. We got to figure out a way to pay down your debt. And it could require some sacrifice, some budgeting, some things like that. But the means to an end, one, are much better, because when you pay off debt, I will tell you, there's no better feeling than that when it comes to your psychological, financial feelings. Debt, in the best way, or the simplest way to put it, is a burden. Debt is a burden. You owe someone money, you're burdened by that owing of the money. So the easiest way to free yourself of burden financially is to not have or eliminate as much debt as you can over time. So be very careful about transferring balances on credit cards. It is one of my least favorite things about the credit card industry, because they prey on people that can't afford to pay it off in 12 months, but they're going to take their money anyway. Closing credit cards can affect your credit score. So you want to be very careful about changing your credit. Again, you're going to hear this word over and over again. Stability is very important. You closing credit card accounts before you apply for a mortgage, just so you know, we're going to see it every single time. It's not rocket science to us. Our credit report gives us a 10-year history of everything you've done credit-wise in the last 10 years. You're not going to hide anything from us, and it could technically negatively affect your overall credit rating by doing that. So be very careful about making major changes to your credit cards, closing accounts, transferring balances, all those things right before or anytime during, the credit card journey or the home purchase journey.
Okay. And no new credit cards, right? No co-signing, no.
Yep, co-signing, be very careful. Parents out there who love their kids and love them to death on it, I would be more of the fan of it with my kids on it. And you can probably think I'm the mean dad or the mean family, patriarch of our family. But I started at about 12 years old teaching my kids about finance. There's not a chance that I would co-sign for my kids. And the reason being is because part of that process is them getting financially ready themselves. As adults, if we keep doing this for our kids as they become adults and things like that, whether or not it's autos, things like that. Now, there are circumstances that it has to happen. I'm not saying I'm that rigid. But for the most part, we see people co-sign for loans on it that have no business co-signing for loans, because if the other person doesn't make the payments, they can't afford it. Right. That is the number one thing about co-signing loans that is very dangerous, and it will negatively affect your credit because you are a signer on that loan. And if they stop making payments, it's going to ding you right away. So be very careful about co-signing for loans and mortgages and things like that.
Okay, moving on. So just again, going over some of the loans, I'm sure you guys have seen it out in the public, but Steve, being the pro on this, is going to just touch base on each of these types of loans that you might be eligible for.
Yes, there's going to be some language in this, guys. This is the language that I'm talking about, and I'll try to break it down in English as much as possible. So a conventional loan is commonly referred to as an uninsured loan. That doesn't mean that there's not mortgage insurance on it or anything like that, which is the type of insurance that protects the lender if you put a little bit of money down. An uninsured mortgage means that it is not technically backed by the federal government. The government is involved with the agencies, and those agencies' names, you hear them, you may hear jokes about them sometimes. They've even written songs about them. If you're country fans on it, there's definitely a song out there, and it's about Freddie Mac, and it tells them they can kiss his you-know-what. It was during the financial crisis that the song came out. It was quite hilarious. But the two agencies on the conventional side are Freddie Mac and Fannie Mae. Yes, it is a male and female version of it, but they do have some very different guidelines to the two of them, and allow some options on one that don't allow on the other, and vice versa. FHA, a lot of people think it is the first time home buyer something. I don't know where they get it, but really what it stands for, FHA is a government agency, Federal Housing Administration. It is an insured loan. It is backed by our federal government. And the agency that backs that loan is the Department of HUD. Yes, and that is a very important factor on it, and is probably the most utilized loan for first-time homebuyers, to be honest with you. USDA loan, in English, it is a rural property loan. You've had you're a country person, or you're just tired of dealing with people all the time on it because they're all up in your business, whatever, and you want to get a little space in your life. You want to move out to the country, the USDA loan is there. It is 100% financing loan. It is one of two out of these four loans. There's technically only 200% financing loans. The USDA is one of them. It is considered probably the second most superior type of zero down financing, only to the number 4 one, which is VA. The one thing to know about USDA in general, it is the single hardest loan to qualify for, because it is not backed by HUD. It is backed by USDA. And they do not have the budget that HUD does, because HUD is a housing initiative program. USDA is technically an agricultural initiative, and they deal with farms and livestock and things like that, and housing is secondary. So they make sure on those loans that they have a very low default rate or failure rate. So they make it very hard to qualify for those type of loans. VA loan, simply, it is for active duty military, active duty guard that meets the requirement, or veterans, whether or not they're disabled or not disabled. The only requirement for a VA loan, above and beyond the eligibility timeframes for active duty people and the number of years of service they had, is that you have to be honorably discharged. If you have a dishonorable discharge, you lose all of your VA benefits. Therefore, you would no longer be eligible for a VA loan as well. That is a very special loan for our military veterans. It is a great loan. I am a huge proponent of the loan, and it gives veterans some opportunities, because even though they make more money than they used to, they tend to be servants as well, and they don't make the money that most people think. And they tend to get called to duty at the most awkward of times on it, that can really stress their family financially on it. So they do really try to help veterans out a lot, because when they get called to duty, they don't get to say no. They have to go.
And not to overwhelm you tonight, but when we say zero down, I just like to reiterate that just means a zero down payment. There are still some fees that need to be paid at closing when we talk about closing costs. So, and I recently heard that there are some new builds out in Vail that are doing USDA loans. So that's kind of different.
Yep.
Okay. This is a time, if you guys can participate, we like to ask you, what do you think you can or can't use for down payment and closing costs? And it might be, Steve wanted you to put the positives. So if you want to use the numbers, can you use your 401k retirement account, gifts, stocks, bonds, cash, credit card, loan, or undocumented cash? And if in the chat you just want to put what you think you can use, you can put the numbers down there. We'll see if anybody can give us some answers to this. Please. Is anyone still there? All right, we got the 401k voted for, gifts, stocks and bonds, and we do have one undocumented cash, so we do want to speak to that.
Yep.
1, 2 sound good. Yep, we're getting some good answers there. Anybody else want to give a shot at it? Okay, well, we appreciate you guys participating. And Steve, you want to tell them what the right answer is?
Absolutely. So the correct answer is, and I'm going to explain a little bit on one of them when we get there on it, but the correct answer is 1, 2, 3, 5, and 6. So a couple of asterisks around 5 and 6.
Yeah.
The loan has to be secured to an asset. In other words, you cannot get an unsecured personal loan for down payment on a mortgage unless it's VA. VA has special allowances because they don't necessarily have the ability to save a ton of money, especially if they're being deployed and they've got a family there and they've got expenses here and all of those things on it. So other than a VA loan, an unsecured loan cannot be used for down payment. However, loans from a 401k can be used for down payment. Loans from an IRA, loans from technically an employer. We can do loans from an employer that aren't secured, but it is a function of your employer that they offer first-time homebuyer loans for people to get them access into homes as a perk or a benefit of working for that company. Undocumented cash, that's a fun one. So undocumented cash, so I'll tell you the big no-no. If you're one of those people that takes your paycheck, you deposit it, and then it goes in, and then you go to the bank and you withdraw all your money. And you keep it in a safe because you don't trust banks, and the world's going to take all your money away, and the government's going to come after you. Whatever the stories that we've heard over the years, there's some funny ones on it from there. But if you have $10,000 sitting on the sidelines and you walk into your bank and deposit it into your bank account right before you're going to buy a home, we're not going to be able to use that money. So there are ways to use undocumented cash. It normally requires a family member. So because we look for source of money, and when it's undocumented cash, we have to deal with what's called the Patriot Act. So we need to make sure you're not laundering money for terrorism and or drug sales / cartels. So those are the big things that we're looking at, and cash is the only thing we can't trail. So how we deal with undocumented cash most of the time is we say, do you have parents that live in town, or do you have a brother that lives in town? Yes, we do. Perfect. Do you trust them? Yeah. Perfect. Give them the money, have them deposit in your bank account, and they can gift you over the money, and no questions will be asked on your undocumented cash. Yes, I just gave you the way to get around undocumented cash, but I will tell you the number one deal breaker for us inside of a transaction is when somebody tells us they have $20,000 in the bank, and we get their bank accounts and they have $200 in it. They're like, oh yeah, well, I withdrew that money 2 months ago and put it in my safe. That's a problem for us. So we need to find a different way to get that money into a financial institution where we can verify where it came from, to know that it didn't come from drug sales and or laundering money for terrorism. So it's not an absolute no, number 6, but it is something that does require a lot of verification, and we have to do some finagling. 401k and retirement accounts on it, the tax laws change every year. It is an eligible source for down payment, and administrations change. This isn't a political conversation. I know there's a lot of talk about using your 401k without penalty. The current tax law states very simply this: you can withdraw up to $10,000 penalty free to buy your first home with a 401k or an IRA or a retirement account. Penalty free does not mean tax free. So you are going to get taxed on the money, but if you withdraw money from a retirement account before you're 59 and a half years old, unless you qualify for one of the exemptions, requires a 10% penalty assessment by the IRS because you withdrew that money early. So there are some benefits to be using your 401k, but we will talk about the pluses and minuses, the positives and negatives of taking out a loan versus withdrawing that money, because there are pros and cons to both. Stocks, bonds, and cash, we can use that. Credit cards, under no circumstances because we use any money from a credit card, including VA loans, to use down payment on a home.
And we do have one question in chat. What is the total amount you can gift money to a family member? Is there a limit?
So I have one clarification question for you, Samsung, before I answer that question. Are you talking about it from a lending perspective or from an IRS perspective?
Can you see that? I'm 66.
Yep.
Can I take my 401k to give to my daughter?
Lending. Okay, so the answer is there is no limit from a lending perspective. And at 66 years old, you would have no penalty. So you would be able to withdraw that money without penalty. You would just be taxed on that money. So there is no limit in terms of the gift. I did give you some insight that the IRS has some different rules. So I believe it's 19,000 this year. I don't know the exact amount, but if you receive a loan or a gift from a family member, the common misconception is that if you go above the limit for each year, and I'll get the limit and I'll put it in the chat once I get down here because I need to Google it because it changes, and it just changed in January, and I don't know the limit for this year, but I'll get it to you very shortly. Let's assume that limit is $19,000. So if you give your son, daughter, or your parents a $50,000 gift, most people think it's taxable. It's not taxable at that point because a gift is considered it falls under the inheritance tax requirements by the IRS. The inheritance limit right now is something like $11.35 million. But what the IRS says that you have to do is you have to declare that gift, because they're going to keep an accounting of the amount of gifts you get over your lifetime. And as soon as you eclipse 11.35 million or whatever that number is for 2026, you're going to get taxed on the whole amount. Prior to the 11.35 million, you just have to declare it. There is no tax that you have to pay on it.
Okay, good stuff. All right. Well, I think one more here on the finances, guys. So this is another question on what fees will be paid before at closing. Well, frankly, all of these are things that we're going to have to deal with. So there's going to be an appraisal if there's a loan. There are title and escrow fees for those folks doing their work to get the title work ready. There are prepaid taxes and insurance. Can't get away from taxes and insurance. And we will want to have home inspections for sure. And we always joke if it's not if, but when you get termites in Arizona. And so definitely one of those. And it's VA, I think, is maybe the only one that positively requires it for the loan, but it's always a good idea to have that. So Steve, you want to speak to those?
Absolutely. So an appraisal fee, it is something we do when we're going through your pre-qualification process. We let you know it is technically an inspection and evaluation both. The reason why it is paid for in advance, though, is because an appraiser does not work for the lender. They work for themselves, and the lender is contracted them for employment, which means as soon as they do the service of the appraisal on it, they are required to be paid. Even if you don't close escrow, they did a service, you owe them money, is the idea behind it. Title and escrow fees, they are rarely, and I've never actually seen one, they're never paid for in advance, but they are part of your closing costs when buying a home that we have to account for in your down payment. Prepaid taxes and insurance. This is also something that is normally paid at closing. Even though it says prepaid, it is paid at closing because technically in almost every scenario in every state, definitely in Arizona, the prepaid taxes mean that we're setting aside money to pay your taxes in the future. So this is part of the language. When you hear prepaid taxes, you think they're already done and we prepaid them for you. But we're technically saving money for the future for you to pay your taxes on your behalf. Home inspections, under no circumstances should anyone, I don't care if you bought 100 homes or this is your first home, you should do a home inspection on every single home. The reason being, there is a fundamental thing that is on the first page of an Arizona contract that states buyer beware. What that means is it's your job to do the due diligence. And by not getting a home inspection, you're literally walking into a home, and unless you can see through walls, I haven't figured out how to do it yet, even with my thick glasses, you're not going to know what's going on with the guts of that home. So it is very important to have a professional. They normally have a building experience. They're normally contractors to some extent, but it's very good to get that detail and that information when they go through and they pick apart the home that you're going to buy and tell you everything that's wrong with it.
And we're going to go over that in a minute.
Yep. And a termite inspection. For Arizona properties, especially on it, termites are a very real thing on it. And they exist. It's not whether or not there's termites in your home or not. I'm going to give you the sad news. There's termites in every home you're going to live in. They're in the place you live in right now. It's whether or not there's an infestation or how bad it really is. So getting a termite inspection to know what you're dealing with tells you two things. One, it's a thought to get you to maintain your home in the future by getting termite treatments to protect your home and protect your investment. Number two, it is also a very good insight into how well the seller that you're buying the home for took care of their home. It is twofold on there because you also have to a certain extent trust the seller. Not that you trust them without doing inspections, but you want to make sure that they took care of the home that you're buying to live in, to love, to nurture. You want to make sure they ideally did the same thing. And if they didn't, you got to be really very, very diligent in your inspections to make sure you uncover as much as you can to make sure you're buying the right home.
And Steve, you usually speak to kind of what do these fees normally add up to, either a percentage or dollar wise?
Yep. So escrow and title fees are really varied on your sales price on it. Honestly, that's a hard one to quantify in terms of how much. The inspection fees, which is everything regarding except for 2 and 3, appraisal fees tend to be $500 to $700. Home inspections are going to say $350 to $600, depending upon what the home has. It could have a pool. Yeah. It could have an outbuilding. It could have a detached garage. It could be a manufactured home. So they can sometimes adjust the fees, but normally somewhere between 350 and about $550 to $600. Termite inspections are normally not very expensive. They tend to be somewhere between $50 and $100.
Yeah. Okay, and then the taxes and insurance might add up a bit. So we've talked about it's going to be several $1,000s for closing costs, and we just again like to remind folks of that. So we do have one question in chat, and we'll pause now. So our Samsung person, Steve, can you see their question?
Absolutely. So when you sell your home, so I'm going to answer this twofold. I'm going to try to be as thorough as possible. So if you've lived in that home for 2 years or more, there is no tax that you pay on it, because unless you've had a $250,000 gain on that property as an individual, or a $500,000 gain as a married couple, you don't pay any tax. And technically, you are exactly correct with what you said, Samsung, that the money that you give to her from the sale of your home, it could be used as something she has to declare as a gift if she goes over the limits, but it can be used for down payment, and that is definitely eligible funds to transfer to it. And in terms of depositing it into her bank account, on whether or not she has to explain where the money came from, it is a question of timing. If you gave her the money 90 days ago and she goes into contract today, she doesn't have to explain a thing. If you gave her that money 10 days ago and we get the most recent bank statement and there's a large deposit on there, we do have to document where it came from. And how we document it is we literally have you fill out a gift letter saying you gifted your daughter this amount of money. And that's how we document it, because it's going to show that it came from you anyway, unless you deposited cash into her bank account, which we know is a no-no anyway. But if it came through a transfer of the bank or a check that you wrote to her, we can document that, and we just have to have you sign a gift letter, and that's all we do to verify that.
Cool. All right, folks. And if there are any other questions, you could either come off, unmute yourself, or put it in chat. And we'll also take some questions at the end, but happy to give you a breath, stand up, run around, shake it out. All right. Not seeing any more just for the moment. Okay. Well, we will move on to our other mistakes. Oh, which it messed it up. Mistake number 3, going to the listing agent to buy your house. This is another one we might get some answers in chat if anybody would think, why would it be a bad idea to just go driving by and go, ooh, I see a sign. Let's call that number and put in an offer with that listing agent. Anybody have any guesses why that might not be the best thing to do? I know you know. But you're also probably multitasking, so I'll give you the answer. So you guys probably know this would be obviously a huge direct conflict of interest. That listing agent has a contract with the seller, so they're trying to make the most money for their seller, and they might not fight for your best interests, and you could end up paying thousands of extra dollars. This is also appropriate to worry about when you walk into a new build, because the person sitting in that office is there for the builder and they may not be looking at your best interest. So if you have an agent, you should have representation, someone like me, to perhaps negotiate a better lot premium, a better appliance package, maybe more closing costs. And one of the most important things we do is schedule a third-party inspection, because as you may have heard in the news, even new builds are not perfect. My really great inspector, he will find a dozen to 25 items that need tweaking even on new builds before we close. So, and they're not going to normally go, oh yeah, you should definitely do that. You probably want somebody again on your side to do that. And so how do you get around that? You hire a buyer's agent. We work for you. There's rarely an out-of-pocket cost because we negotiate our compensation with the sellers. You have a strong negotiator on your side, and not just for the price of the home, but all those repairs that we were talking about. And you do sign a buyer's representation agreement, and that outlines our working relationship. And I do caution you, don't sign it with more than one agent, because you might end up contractually owing more than one person compensation if you go to buy a house. And this is a dear family that I recently helped. Mistake 4, which Steve mentioned a minute ago, skipping the home inspection. I think people might think about doing it because it sounds like you might save money, and it might sound expensive to have a 300 or 400 or $500 inspection, but I have saved my clients thousands and thousands of dollars over the years, negotiating repairs or credits. And Steve, I don't know if you want to answer that question in chat or if we can
I
take.
am, and what I'm just going to give him my email address on it. I'm going to have him email me that question on it. That's a little. I've got to ask some questions personally about it, so I'm going to keep that out of this
Yeah, yeah.
conversation.
So, yeah, and if you guys go ahead, Samsung, you can click the link for the one-on-one and we'll make sure to connect you with Steve if you don't see his info in chat. Or Steve, put your info in chat. So the cost of skipping a home inspection. If you don't do it, these are some of the things we won't be aware of things that could be a deal breaker. Obviously, you guys have seen pictures of flips, and a lot of times it's kind of like putting lipstick on a pig because you can hide a lot of damage by painting a wall or maybe throwing down some new carpeting. But once we have an inspector in there, they're going to be looking at all the critical things that we can't just see on the surface. You lose your negotiating power because we don't know what to ask for repairs or to get a credit for. Risk inheriting non-structural things like mold, they'll be very careful to call out mold unless we see it, and we might pay for a specific mold inspection, and misforecasting future repairs. So, a roof or an HVAC can be a deal killer. They each cost about $10,000, like for a brand new roof or more, and an HVAC. A sewer line could be broken, can be a very expensive repair. You're responsible for the plumbing from your house all the way out to the street, and so it's really good to know that those lines are intact. Other plumbing issues, electrical, structural, those are the things we're looking for, and we definitely ask if we were uncomfortable with any piece of that home, to ask for some of those big things to be repaired. And then again, you don't know the status of termites in the home unless we have that inspection. And as Steve said, they're not that expensive. So having an inspection, super, super important. I have a terrific inspector here in the Tucson area. He's of German descent and he's very specific. And he will find everything that you can with the house. Mistake 5, not taking the HOA document review period seriously. So our last one is just some people say, I don't want to live in an HOA anyway, but if you do, it's just really important to look and see, you know, are they financially sound? Are they going to be raising dues? Do they have any disclosures to that effect? Are there assessments pending? And then, can you live with the restrictions? I mean, some communities don't allow cars to park on the street. To change the color of your house, you have to have specific plantings and things like that. So it's just really good to take your time and do your due diligence, and we'll give you a lot of links to research the house. Go at night, hang out, see what the neighborhood's like. So hopefully all of those are good tips. So we're almost to the end, guys, and we're hopefully seeing how you feel now. Hopefully you don't feel as stressed or concerned or uncertain or anxious. And if anybody's willing to come off mute and talk to us, we'd love to hear from you. I think Steve shared some really great information for lending, and hopefully you guys feel that. I would love to help you with, again, the home buying process in general. But do you feel like your time has been well spent this evening? We really hope so. And do you see how you could be able to start your home buying process this year? I just can't recommend anyone higher than Steve. He just has everyone's best interest at heart. I think that came across tonight. And hopefully then, if you'd like the opportunity to speak with me or Steve and our team, we'd love to see you. And we had our one-on-one little connection. Let's see the link in there if you guys have all gotten on there yet. And if you could please go in and click that link, and there will be some openings for making an appointment with us in the next week. So do take the time to do that, and then just look at the fact that once you do that one-on-one, we'll work with Steve to get the pre-approval, perhaps do some credit work, and then go shopping for your dream house with me. So really appreciate you folks being here. And any other questions? I mean, we've had a couple of good ones tonight. Really appreciate everybody coming out.
Yeah, and one thing I want to say about owning a home on it, like it is a daunting process, but I will tell you, for those of you who value stability or never had stability in your life on it, the biggest thing for me when I bought my first home, and I bought my first home at 23 years old. Things were a lot cheaper than it was easier on it, but I will tell you if you do it the right way and you're doing it for the right reasons, it creates a level of stability and comfort. For me, my family, my home is where my family builds memories. We have a lifetime of memories. I have three daughters. I have a beautiful wife, and our home is where we love together, where we sweat together, we fight together, we do all those things. But most importantly, we build a lifetime of memories that when you're living in someone else's home, and I do mean it that way, because if you're renting, you're living in someone else's home, whether or not it's a corporation or an individual, it's really difficult to better your life too much. Not saying you can't better your life, but it's really difficult to set roots down, because if that seller or that owner decides to change what they want to do, you're going to be forced to move and you're not going to have a choice in the matter. It really is taking control of your finances. As long as you do it the right way within budget and all those things, it can really be a very, very good experience for you, your family, your children, your grandparents, whoever's living with you on it. That stability, we have a very underrated, view of stability today, because we live in a crazy world. Just because the world is crazy doesn't need to mean that your world has to be crazy. And in my opinion, owning a home is one of the simplest ways to create a lot of stability for your family and to take the crazy out of our world today. Because, for those of you who don't think it's crazy, I'd really like to talk to you on it, because it's just crazy, some of the things that happen today. But I think most of us are of the same opinion. And it really does offer something that is really hard to identify, money wise. Like, what is it? What's the benefit? It's the emotional and psychological benefit that you're in control of your life. For all the things that we can't control, you can control this. And that alone gives your family a lot of stability and comfort, knowing that they get to go home every day to a place to sleep, to eat, to enjoy, to laugh, to cry, all of those things. And that's what a home provides. And it is a very big part of, it's been a very big part of my life, my family's life. And it can create wealth if you do it the right way as well. But that is really secondary to me on it. It's really about the stability of what it provides for your family and the people that you are helping or living with. Or if you live by yourself and you want the stability and privacy, it offers a psychological benefit that most people underestimate.
I think all that's true. And I know we hear that, uh, when you're renting, you're paying 100% interest. So when we're worried about, interest rates are going down now, and affordability is still an issue, and we totally understand that. But again, it is a game changer for folks, and that lifestyle that Steve was just mentioning is super important. But it is also really great to build equity in your own life, and have that ability to grow that wealth. So again, we thank everybody for being there. Please check the link out, click in there and do your one-on-one chat, and we're happy to hang out for a couple more questions if anybody has them. But I appreciate your time tonight, and look forward to hopefully following up with you, and getting a one-on-one and talking you through your own roadmap to homeownership. So thanks again for being
It was a
here.
pleasure, guys. Appreciate the time.
Thank you, Steve. You're always a wealth of information. And thanks, everybody. All right. Just leaving that chat in there for a couple more minutes if everybody can grab the link. Thank you guys for showing up. Hopefully your first step toward homeownership. All right.
All right.
You're good to go.
I think we're good to go. Appreciate everyone tonight. Thank you for your time, for sure. We appreciate it. We know lives are busy on it, and we appreciate it.
Yeah. Thanks, guys. All right. We'll see you later.